Welcome back to Alberta Primetime. On tonight's Vocal Point, our Monday Money panelists talk about your tax refund, if you're lucky enough to be getting one, as well as your asset mix, advice on choosing your various nest eggs, plus the changing outlook of our oil sands sector. Jane Alm is a senior investment advisor with Angus Watt Advisory National Bank Financial. Russ Dratwa is a senior investment advisor with Canaccord Wealth Management. And Shafik Hirani is a senior executive financial advisor with Investors Group Calgary. Good evening, everyone, and welcome back to Alberta Primetime.
Good evening.
Good evening.
Hello.
We'll talk about how to best divvy up your assets in a moment, but first, tomorrow is the deadline to file your annual tax return. A recent Bank of Montreal Nesbitt Burns survey reveals 80% of Canadians expect to receive a refund. 37% claim they will put the money towards their debt. 20% said they would invest it in savings, such as an RRSP or tax-free savings account, compared to 10% who freely admit they'll be treating themselves to a vacation or luxury item, and 7% will plan to use the money for home renos. Shafik, what do you think? Why is paying down debt maybe the best strategy? Do you agree with that necessarily?
No, Jennifer. You know what? I don't. First of all, the Egyptians, they built the pyramids wide before they built tall. And building wide means you have to buy your RSPs, you have to get a tax refund. And the government gives us a limit for a reason. If there was no limit, nobody would ever pay taxes again. But when you get the refund, I mean, first of all, of course, a vacation's great, and it's more fun when the vacation is on Revenue Canada than paying for it yourself. But we have to understand that when we get that refund, the money that in our RSPs that have usually created that refund, that's not a tax deduction. That's down the road. We're actually going to have to be paying tax on that. So what you might want to do is build the asset first instead of paying down debt, because debts right now are at a very low rate. We're carrying debts usually at 3%, 4%, 5%. So in my opinion, no, it's not the best thing to go pay off a bunch of debt, especially if you're deducting that debt. Now, if the debt's at a credit card or a line of credit at 10 to 12 to 15%, yeah, then, you know, mathematically pay that stuff off. Otherwise, learn other strategies to make the money work for you rather than you working for it.
So invest that money. Jane, do you agree?
Well, I agree exactly with what Shafik is saying. You've got to look at the interest rate you're paying on the debt. You have to do some math and figure this out. You know, if you've got the money and it's coming in and you're going, okay, what am I going to do? Tax-free savings account is a great place because that one is, anything you earn is tax-free. You can put the money in, you can take it out. You can also use it as an RSP contribution. If you know that you don't have a pension plan and you don't have other contributions and you're going to have to put in $20,000 this year and you get some money back, you can use that as a down payment, if you will, on that RSP contribution. Make it maybe a little more comfortable for yourself through the balance of the year. But you need to weigh all those different factors.
Russ, what do you think is the best way to make the most of a return if you're getting one, or a windfall at any time of the year?
Any windfall, if you're getting where you want to be in life, if you're meeting your objectives, then by all means. I saw the beach picture there on the TV, which is great. But I think it's more important that you break it down to whether you're a saver or not a saver. If you're not a saver, this is probably the buffer zone from the Christmas holiday season just to catch you up. So that's always a good thing if that's the person, that's the scenario you're in. But if you are a saver and you do have your nest egg and everything's on track, then why not? But what you might want to consider to be a devil's advocate is talk to your human resource department, and that windfall, that rebate, you're just paying too much income tax. If year after year after year you're getting a tax rebate, then perhaps you can get your human resource department to reduce the amount of income tax you're paying so you get it every paycheck. Food for thought.
Invested in some kind of a savings vehicle after that.
On a monthly basis, absolutely.
Shafik, there's the other problem, having to pay a tax bill, and some Albertans in that bracket. How can you plan and save for that and manage that to your advantage?
Yeah, you know, that's a tough one, and a lot of times I see people trying to save on their grocery bill and save on their utility bill, and people forget that our tax bill is our biggest expense, and if we haven't, you know, made 40% of our income goes to tax. If we haven't made that payment, then we got to figure out how we're going to pay it. The one thing people shouldn't do is they shouldn't avoid it and file late, because anything that's late, you're going to pay a 1%. You're going to pay a 5% penalty plus 1% per month on the outstanding balance. So how do you pay the bill if you don't have money saved? You can get a line of credit to pay the tax bill. usually at a lower rate, and make sure you automate the process so you pay by installments for the next year, so you're not left in trouble the year after.
Alberta, of course, one of the provinces in the country with the most cell phone businesses. If you're constantly behind the 8 ball at tax time, take a little more off every month. Ask your employer maybe to do that for you if they're leaving you short.
And if you know that, historically a lot of people, actually you don't even have to be high income earners. If you work 2 or 3 part-time jobs, you can end up owing tax because on the part-time employment, none of the employers know exactly how much you're making.
Right.
So you have to be more diligent. You have to set up, whether it's a monthly savings plan into a savings account or a tax-free account or something, so that you have that money to pay the taxes come April. You don't have to pay those penalties.
We're down to the last minute now. Tomorrow's the deadline. Russ, do you run to the outlets set up in the kiosks at the mall, or how do you handle that?
Tis the season. What I always encourage clients to do, unfortunately, well, not unfortunately, my first 15 years was certified financial planning, so that, like Shafik said, taxes is such a huge part of our lives. Tax Freedom Day is something like June before we get into the money we earn is ours. I encourage people at this point in time, we tend to get reactive. Become proactive. Even if you don't have a tax advisor, once every 3 to 5 years, you should sit down with the tax specialist to
pay the money
to at least see. And with today's software that you can get at your local, it's just amazing, the tax tips and all that. So
it's just the chore we hate, though. That's the problem. That's where the procrastination
like those
comes in.
commercials.
Shafik, tax time can get us thinking about our overall financial picture. If we've got some assets, how do we make sure that we have a good mix? What should we know about allocation? And maybe explain for people, they might not think they have assets worth allocating, but might be surprised to find out they do.
Yeah, and a lot of people would be surprised. The biggest investment decision any advisor has to help people with is what is your asset allocation. There's 5 different asset mixes. There's equities, which are like equity-based mutual funds, stocks. There's fixed income, which are bonds, government corporate bonds. There's cash, which is like Canada savings bonds, treasury bills, money market funds. There's real estate, which are real estate trusts, and then there's hard assets. And the big mistake people make is they put most of their money into one aspect. A lot of people have too much money in real estate in their houses. You want to make sure that the asset allocation decision is designed to protect your capital. It's not designed to make you rich, it's just designed to make sure you don't go broke. So put all your eggs in different baskets.
Jane?
Well, the asset allocation, as Shafik said, is actually the most important part. And part of that is understanding your objectives and who you are. Are you a saver? Are you someone who's risk adverse? Do you like a little bit more risk? Where are you in your earnings career? Are you counting on that money that's there to earn an income for you and provide for you the rest of your life? And the other component is, if you're older, regardless of who you are you looking at leaving a set amount of money to your family, to a charity? If you are, you need to plan around that, and you need to try to devise that asset allocation to meet it. So it's not age dependent, it's more dependent on personality.
Before we wrap up, common errors with asset allocation, Russ?
I think the key is to know, if you can get where you want to be with a 2% rate of return, why on earth would you have any equity in your portfolio? So that's one of the things you have to understand is where you're going, and that should help determine what your asset allocation mix is.
Very individual. Next up, the outlook for Alberta's big economic driver, our oil sands. It has been turned upside down from a few years ago. How will our big sector weather the change? That's when the Monday Money Panel returns here on Alberta Primetime.
Hair care services for Jennifer Martin provided by Charisma Hair Fashion.
Welcome back to Alberta Primetime and our Monday Money Panel. Jane, an analyst at your firm today issued a hot chart showing just how much U.S. oil production has risen recently and how U.S. OPEC imports have dropped. Also a Canadian figure in there.
There is. What this chart shows on the left-hand side is the imports into the U.S. of foreign oil. So we can see a declining line going from the upper left to the lower right. What we also see on the other side of the chart is that OPEC's imports into the U.S. are declining while Canada's are actually growing at this point in time.
Right.
What we have to be very cognizant of is that as the U.S. is producing more oil, importing less oil, that at some point that will affect what Canada also can import into the U.S.
Why are they still importing lots of Canadian oil and less OPEC oil?
Well, they like the security of Canadian oil. It's also a lower cost because it would be on the WTI price versus the OPEC oil that would likely come in under a Brent price. There's also the factor of the political from Iran. There's all other demands on the OPEC oil.
Shafik, U.S. approval of the Keystone XL pipeline is on perpetual delay, yet one oil sands producer, Imperial, says production at its Kearl project will double imminently, and at Kearl as well, the emissions are now comparable to a U.S. refinery, so a huge green step there. But we've got that bitumen bottleneck still. Are we still in safe territory?
Well, so far, they're going to have to address greenhouse emissions. Yeah, Richard Kruger said that. He's the new CEO of Exxon. He took over March 1st, and Kearl's a big project. It's online eminently. It's about 110,000 barrels a day. They need to get pipeline capacity. If they don't, then it's an important deal. And, you know, they can look at alternative ways to get the bitumen to the States or cross-border. They could look at rail. But the pipeline approval is important. Otherwise, you're going to see companies have struggle in the next little while.
Russ, how long before we really adjust performance, especially for investments in oil sands, our expectations for fueling the Alberta economy? You know, the Keystone XL pipeline delay is one thing. Kearl's saying it's going to double production imminently, yet at the same time, the U.S. is producing more of its own oil, needing less imports. It's hard. The whole outlook on our oil sands has completely reversed from 5 years ago.
Well, market demand and thereby the price paid will dictate if this gets done. I mean, the market seems to think there's an 80% chance. That seems to be what's baked into TransCanada's. But governments will always do the right thing after they've exhausted every other option. So, I mean, right now we've got Brent at $104 a barrel. West Texas is at $94 a barrel. And the spread for the heavy oil is really tightened as well. We haven't seen these. So it is looking more appealing. But they look at this for a 10, 20-year time frame, not a minute pocket.
Right. So still safe for now. We'll keep watching. In the meantime, we want to know what else is on your radar. What are you watching from your desk in Edmonton?
A European Central Bank meeting. There's much discussion. Will they cut interest rates and therefore stimulate the European economy? It seems like Europe's had enough of austerity. So this meeting, we're looking for potentially, I think there's a 60% possibility of a 25 basis point rate cut in Europe.
Shafik?
Tomorrow their GDP is announced in Canada by Stats Canada. You know, GDP has declined. They're targeting 2% growth, but it's probably going to come in around 1.3 to 1.5. A surprise in the upside would hopefully be good for Canada. And on Friday, the U.S. unemployment numbers are out, and hopefully unemployment in the United States is under 7.5%. If it is, markets should do good. And
Russ?
For those keeners that pay attention to their equity markets right now, you really want to pay attention to the bond markets. It's considered the smart money. And with the U.S. Feds in Europe, what they're doing with interest rates, right now a U.S. money for 10 years, 1.7%. Historically, it's between 4 and 7.
Yeah.
So that's telling you that there's still a lot of uneasiness in the world. So watch the bond markets, believe it or not, what the 10-year rates are at.
Thank you all for joining us tonight. Jane Alm is a senior investment advisor with Angus Watt Advisory and National Bank Financial. Russ Ratwa is a senior investment advisor with Canaccord Wealth Management. And Shafik Hirani, a senior executive financial advisor with Investors Group Calgary.